Welcome to CPE Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. During today's Outlook for 2025, we'll be addressing key questions that may be top of mind as we head into the new year amid a shifting economy. I'm Suzanne Silverman, Editorial Director of Commercial Property Executive, and I'm here today with five leading industry experts: Steve Quazzo, co-founder and CEO of Pearlmark Real Estate; Alexandra Levy, America's head of debt capital markets for LaSalle Investment Management; Barbi Reuter, CEO and principal of Cushman Wakefield PICOR, and well known across real estate social media for her insightful input; Shlomi Ronen, managing principal and founder of Dekel Capital; and Ryan Severino, chief economist at BGO. We're recording this session, and it'll be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. And thank you to those of you who submitted some in advance. We'll try to get to as many as possible. First, though, Ryan, could you set the stage for our discussion?
Sure thing. Thanks, Suzanne, and thanks everyone for joining today. Just very briefly, I just wanted to, as Suzanne said, just set the stage. We've been in some interesting, I say that euphemistically, interesting places in the economy over the last 3 to 4 years. I think the context is important and really matters. And so with that, I'm going to start with the 800-pound gorilla in the room, which is inflation. I think, as everyone knows, we went through a period of multi-decade high inflation, peaking, let's call it mid-year 2022 across various indices. I think what really matters for us, irrespective of pick your favorite index and your favorite measure, is that inflation has slowed considerably over the last, let's call it 2.5 years. Let's round up a little bit. Hundreds of basis points of inflation decelerating between mid-2022 and where we are today. A lot of that had to do with the supply side of the economy really righting itself. We shut it down during the pandemic, took some time to bring it back online, especially with China maintaining lockdowns for a prolonged period. It also didn't help in early 2022 that we had the first major war in Europe for the first time since the end of World War II, which caused obviously energy prices to inflate, but also caused food prices to inflate. Very critical, both as inputs to production, certainly, but also just the way that consumers go about living their lives. The good news is, as I said, we have been on the backside of this for about 2.5 years. We haven't seen maybe quite the progress that we'd like to see, at least in the headline indicators. I'll spare you my diatribe about why I think we're measuring inflation wrong in the US, or at least not as accurately as some other parts of the world. But the good news is we have made that progress, and the worst of this is now in the rearview mirror, which matters because if we go to the next slide, we needed to do some things in order to not just be sitting idle and letting inflation run its course. Again, I think the empirical research is pretty clear in showing that a lot of this was a supply side phenomenon, but that didn't mean the demand side of the economy had no role to play in this. And that's where central banks like the Fed stepped in very aggressively. You could see on the slide, we went from early 2022, when interest rates were essentially at zero, at least at the short end of the curve, to where we ended up in the latter stages of last year, up 550 basis points effectively from where we were. And we stayed pretty elevated until about the third into the fourth quarter of this year, when we finally started to see the Fed easing. It took until September of this year. They backed off 50 basis points. Last week, they backed off another 25 basis points. They increasingly have confidence in this deceleration trend in inflation that I was just discussing, which I think leads me, and I think most objective economists, to think that over the next 12 to 24 months, they'll continue to pull back on the short end of the curve, moving closer to their neutral rate over time, or at least their estimation of an unknowable neutral rate. They'll probably take them, let's call it 12 to 24 months to get there. But I think one way or another, even if the pace of rate decline is not what everyone in the market would like, we are almost certainly headed lower from here on out. As we'll discuss a little later, that has implications for the long end of the curve. But I think what really matters is how the economy has been faring in the context of that. And you could see the economy has been nothing short of spectacular, really since the economy started to grow coming out of the acute lockdown phase of the pandemic in the third quarter of 2020. By the latter stages of 20 into early stages of 21, the economy was off and running again. And really since then, we've had maybe one slight hiccup in early 22, but that more had to do with inventory adjustments in international trade, which I could probably argue said more about what was going on in the rest of the world than what was going on here domestically in the US. But that is a spectacular run given everything that we had to go through over the last 4 years between having the pandemic, locking the economy down, having to reopen it, having inflation accelerate, having to raise interest rates really aggressively, despite all of those things over the last 4 years, some of which were, I'm going to use a word I hate, but I'm going to use it anyway, some of which were unprecedented. We've managed to come through this with flying colors. And we now sit more than halfway, about, let's call it halfway through the fourth quarter at the end of the year. And I would say the economy continues to maintain solid momentum. And we're heading into 2025, I think, in a pretty healthy pace in terms of where inflation is, where interest rates are likely headed, how tight the labor market is, and just how strong production and GDP has been in the economy. So with that, I will turn it back over to Suzanne, but I'm sure I'll have some other thoughts as we progress through the discussion today. Thanks very much.
Thank you so much, Ryan. Now let's get a few details on what it's like to operate in the current market and what's changing. And I'd like to hear from each of the other panelists about a recent debt or equity deal that you were involved in that really illustrates that. And Steve, maybe you could start. Could you provide us with a short example?
Sure. Pearlmark is an active U.S. investor in the middle market space. You know, we do both debt and equity through closed-end funds. And I'll just pick a recent debt deal because I think it's emblematic of what we're seeing a lot of. We recently closed on a mezz loan here in suburban Chicago on a newly constructed apartment property that's up to about 90% leased, so almost stabilized. And it's it's with a borrower who's looking for two additional years. The senior lender, the construction lender, wanted to right size their loan. Previously, they had said they would never allow mezz behind their debt, but in order to accommodate a good client, and in order to, as I said, right size their loan and probably appease regulators, they agreed to do it. So in many ways, it was really a win-win-win. We basically took the 60 to 72% part of the capital stack, paid SOFR plus 775. That's the cost of our mezz, so not inexpensive. But and we get a floor of about, I think it's 4% in this case. So the way I look at it, you solve the bank's problem, you solve the borrower's problem, because 2 years from now they'll be stabilized. The concessions will have burned off. They'll be able to refinance the asset with one of the agencies or sell it. And obviously, from our standpoint, we're thinking, wow, this is an institutional quality, brand new asset. Our last dollar is at 72%. We're getting paid SOFR plus 775. Our yield on cost to our last dollar is 8%. So I think we're good. So I think you're going to see more of that. We have a lot in our pipeline. We've done a number of those type of loans. And as I said, I think it's representative of what we're seeing out there.
Thanks. Thank you, Steve. Allie, do you want to talk about one?
Thanks. So Allie Levy, LaSalle Investment Management. So just like Steve and Pearlmark, LaSalle invests across the spectrum, debt and equity, all property types. So similarly, trying to understand where the debt market is for good performing office in a backdrop of very difficult office financing. So earlier this year, looking at a stable office asset for an SMA account and how to go finance that asset because it was rolling off of an existing loan. And went out really broad, trying to find what we were thinking was going to be a unicorn bid from a life company. Actual execution, though, was within the CMBS market, which is not where we typically play. But at 40% leverage, we were actually able to get very attractive CMBS debt on a 5-year basis, borrower only. So, very great execution given where the market is, but also really looking at what the options are in a challenging market for office.
Thanks. Shlomi?
Sure. Similarly to what Stephen had mentioned, we're seeing quite a few recapitalization requests. We're working on one right now in Texas where sponsor is bought an asset in 22, did partial renovation, value-add renovation, and essentially stopped because rent growth stopped, and they just weren't getting paid for the renovations anymore. So coming to the end of their loan term, and we're helping them recapitalize the asset with a new fixed rate senior, taking out the floating rate bridge debt, so lowering their borrowing cost, but at the same time, there's an equity gap that's there because we're not getting to the final dollar of the existing loan. So having to bring in preferred equity or mezz that, again, as Steve mentioned, today's pricing anywhere from like 12 to 16%, depending on the risk profile.
Okay, and Barbie.
Yeah, so we're all advisory, third-party brokerage management advisory services. And so I can highlight a significant, for us, transaction in our market here in Tucson last month that really filled a community need. One of my partners, kind of highlighting this importance of relationships and relationships matter, was able to bring together an investor developer client and a community, really a federally qualified health center who had growing need and a significant backlog of patient demand to reactivate a really 15-year vacant former heart hospital, about 95,000 square feet. And so, with a purchase price of around $8 million on this asset with a bit of excess land, I think all in hard and soft costs when it's done will probably be another $35 to $40 million that they put into the project. But really a nice example of bringing these entities together to fill a need and matchmaking, if you will. It's a 20-year lease with a purchase option for the health organization, and one that was handled just in October.
Great, thank you all. Let's jump into our discussion. And Steve, I'll start with you as we start to zoom in, but keep it still a little bit broad. What are the main issues that you feel we should watch for next year, and what are your biggest concerns?
I'll focus more on my book, three things that at least we're going to be focusing on. One is an industrial, the vacancy rates have, crept up. I mean, they're still, pretty strong, but, nationally it's about 7%. Maybe if you took just institutional quality assets, it'd be half that. But there hasn't been a tremendous amount of leasing this year. And, there are a lot of reasons for that, but, maybe now the election's behind us and, Ryan's kind of rosy picture of the world will sort of hit some of these corporate executives. I mean, so I'm really going to be looking at absorption, over the next year in industrial. That's something, in markets. I mean, look, Texas has gotten a lion's share of the absorption over this last year. But, going forward, we're active in markets like, Greenville, Spartanburg, Atlanta, Nashville, and, hoping to see more space get leased. So that's one thing we'll be looking at. In the apartment sector, you have, new construction down half of what the peak was and still well below the 50-year, annual average. So that's a good thing. The tough thing that we've seen is rents, right? And so, we're going to be looking at hopefully rent growth in 2025. Hopefully the concessions that we're seeing in the marketplace, these 4 to, or actually more, maybe even 6 to 8 weeks free on 13+ month leases, go away. Markets like, Dallas and Charlotte and Nashville, Austin, places like that. So that's something that we're going to be, very focused on. I think the underlying fundamentals are still really good in multifamily. If the economy grows, job growth, that'll all translate. We don't need the 20 and 30% growth that we saw, a few years ago, but it'd be nice to see some, 4% kind of CAGRs. So that's something that we'll be looking at. And then I think the third thing I'll be looking at and trying to, see, get unlocked is, are banks really going to start selling assets and clearing, for clearing prices, for real market prices? We haven't really seen that. We've seen it maybe a little on the office side where we're not a player much at all. But in apartments and in industrial, I'll be curious to see, because I know there are a lot of problems on their books, and I know they're pretending and extending and recapping it like many of us described on the refi side. But at some point, these assets got to hit the market and get sold. And so, we'll be looking and tracking that and hoping, we can pick some off.
Thanks. Anybody have anything to add, or shall I go on to the next question?
I'd say the debt funds also kind of continuing Steve's kind of thought process there is just, and I'd say more so than the banks, they've got a lot of troubled assets on their books or potentially troubled assets on their books that they've continued to be very flexible for a number of reasons in terms of the way they go about doing loan modifications. And we're just now finally starting to see them start to draw a line in the sand, although again, the depending on how they are leveraged and how they're structured on the back end is really gonna have a lot of impact on the types of modifications that they're able to or willing to continue to do. So I think that should help drive some transactions next year as some of those extensions come to an end. And at this, kind of along the same thought process, I think we all should be looking at the long end of the curve, because when treasuries earlier, about 6 weeks ago, dropped into the mid threes, party was back on. Everybody felt an excitement, and all of a sudden the math worked, especially on the multifamily side in terms of being able to refinance and get to loan proceeds, with treasury sitting at around 4.4. I actually didn't check where we're sitting today. The math doesn't work again, and you need fresh equity to come in to be able to recapitalize and move those assets forward.
And I do want to talk some more about treasuries, but first, to go back to kind of, I guess, the elephant in the room that Steve, you referenced, Election Day obviously was a week ago, a presidential election. Does the outcome at the federal level make a big difference to real estate? And Barbi, I'll ask you that. How much of an impact do federal level initiatives and legislation tend to have on commercial real estate?
Oh, isn't the buzz on the elections really a lot of fun? There's so much to talk about, but at its core, and Cushman Wakefield and others have done a nice job of mapping election cycles against property performance and showing that there's really no correlation. So from kind of an overarching performance standpoint, I don't think that there's much to watch there, but the impact on fundamentals is minor. But we also do see that solid GDP growth could impact leasing positively. I think that in our area, we'll be looking to see if potential changes in immigration policy could affect labor markets. Certainly border states and others are impacted. Let's see, what else? The local economic development agency pipeline in our region is heavily weighted toward clean energy and semiconductor. And so, because of policy changes, there's some concern about that pipeline and what that means for job growth. So that's kind of my perspective. I'm sure others have more to add.
Are there any locations of particular concern due to state or municipal, more local level policy? One of the things we were talking about during our planning meeting was the fact that while there can be some impacts at the federal level, a lot of impacts on real estate are at the state level or more of a local level. Any particular locations to watch?
Well, I think in terms of impact locally, that it is the municipalities, the states and the municipalities that really have to respond and deliver. And so infrastructure is crucial for commercial real estate growth, and investment in that can enhance sales. Which municipalities can deliver power today is extremely critical. 4 of the 5 fastest data center growing fastest 4 of the 5 fastest growing data center markets are in the Southwest. And, Phoenix is among those. And so delivery of power is really critical. I think also you hear in the national news some concerns about water availability, and myths about scarcity of water in much of the state of Arizona are really overblown. We have requirements for an assured water supply before development can occur. And then I think lastly, I'd say that local zoning and incentives and how they adapt to changing times is also important. This idea of adapting parking requirements and meeting the needs of affordable housing come to mind.
As an investor, I can tell you there are a couple markets that have been redlined. Good news is here in Chicago, we have a lot of water. The bad news is we have a lot of taxes. And so I think this is a market that a lot of institutional investors are extremely wary of, in spite of many of the good fundamentals. We have a governor who tried to put through a higher income tax that was rejected at the polls. We have a mayor in Chicago who tried to put through a transfer tax that was rejected at the polls. There's a lot of pressure to raise property taxes. And guess what? Out-of-state landlords don't vote. And so you guess who's going to get the bulk of that hit. So that I think Chicago's an issue. I think LA is an issue too, with their 5.5%, transfer tax. I mean, that is significant. And that went into effect, I think, last April. And I know there's some litigation, but I think that gives a lot of potential investors pause in that market as well.
Ryan, you gave us a nice overview on interest rates with that great slide. How do you feel the real estate market's response has been to the Fed strategy and to the current rate of inflation?
So there's kind of a first order effect to that and sort of second order effect. First order effect is we've only seen some, I'll say, tentative signs of stabilization in values and pricing broadly. If you look at any of the, the major indices out there, any of the ones that, say, NCREIF puts together, or some of the other organizations, you haven't seen a sea change there in terms of valuation just yet, marginally. But where I think beyond the first order effect, you're starting to see some changes, kind of second order, third order, is the sentiment shift in the market. Because I think, as everybody on this call knows, it hasn't been the economy and market fundamentals that have really been holding the sector back for the last 2.5 years. It's really been on the capital market side, because when you go from a Fed funds rate to 0 to 550 basis points in 18 months, there is going to be some collateral damage associated with that. And I think as the market has had more confidence that the Fed was going to cut, and I don't want to say cut aggressively, because that's a little hyperbolic, but let's just say more aggressively than they did last cycle, where they, for those of you who forget, they waited until December of 2015 to cut at all. And then after that point, they were still very tentative about cutting rates. I don't think that's going to be the case this time around. The market certainly doesn't think it's going to be the case this time around. The market might be a little disappointed ultimately in the pace from the Fed, but I do think you're starting to see a sentiment shift. And admittedly, that's a little bit of a kind of a soft indicator in the market. But I think any of the more objective indicators of sentiment in the commercial real estate market, I think, are already swinging positive in anticipation of where rates are going, and removing that major headwind from the marketplace. So first order effect, I don't think you're seeing very much just yet, but I think second order, third order effects, you're starting to see people thinking a little more aggressively down the road and about deploying more capital once we're in a different interest rate environment, 6, 12, 18 months from where we are now.
And speaking of which, are we paying enough attention to treasury rates relative to the focus on interest rates?
I think yes and no. I mean, certainly I hear about the 10-year treasury a lot internally. So even if I want to be thinking about what the Fed is doing at the short end of the curve, I think it was Shlomi who mentioned before, right? We're on kind of this roller coaster now with the 10-year treasury, and we're in a period of heightened volatility that goes back, at least 6 to 12 months, but it hasn't abated just yet because the market, in the absence of the Fed, initially starting to cut rates, and now easing into that, the market is reading a lot into almost everything that happens. Every speech you hear from someone, whether they're at the Fed or not, Chair Powell says something and rates go up, and then he says something else and rates go down, and that will probably rule the day for a while, even as the short end of the curve backs off with the Fed. So I would simply say, from my point of view, certainly I feel like I'm paying a lot of attention to it, but I would also suggest that don't be surprised if volatility remains heightened for a while until we get farther down the road for rate cuts, because with almost every seeming thing that happens, whether it's an inflation print or a speech from Chair Powell or a press conference, the market is going to read a lot into what those implications are going to be for interest rates. And you've seen heightened volatility for 12 months. I don't think that backs off too quickly.
Okay, thanks. Shlomi, let's talk about all the value add deals funded by debt funds in recent years that are approaching maturity, the so-called wall of maturity. How long do you see them getting extended before they finally have to go to market?
Again, I think it depends ultimately on how the debt fund is capitalized. What we've seen is the ones that utilize the securitization market for leverage through CDOs have been actually more willing and more flexible with the way they've been extending and doing loan modifications. The ones that tend to be more bank levered have been less so, and kind of been pushing through and pushing pay downs and interest rate caps. I mean, on the one end of the spectrum, we're hearing of groups just extending without requiring anything, just blindly, just literally kicking the can down the road. On the other hand, for example, a deal we're working on right now, that funded a construction loan, and on a $24 million construction loan, they want a $6 million pay down to right size what they feel is right size their loan. So I think next year is really the next 12 to 24 months is really going to be a time period where we're going to see a lot of pressure, and that pressure ultimately leads to transactions. And what the industry's been challenged with is literally just the lack of transactions. And I think once we see that transaction volume pick up, we're going to get a market clearing price and cap rates for multifamily and all the other asset classes that will then help spur other investment activity, because a big question out there right now is just where are cap rates on these assets.
Anybody else have anything to add?
Well, I would agree totally with what Shlomi said. The only thing I would add is that the even bigger opportunities in the banks, if you look at the wall of maturities that you referenced, over the next 3 years, including what was kicked down the can from 24, it's like $2 trillion. Half of those commercial real estate loans are from commercial banks, whether it's the money center banks or the regional ones. And we all know where they are right now in terms of the problems on their balance sheet. I mean, they are on the sidelines in terms of lending. So, that has to be resolved, and private credit can solve some of it, but it's a huge vacuum to fill. So hopefully, some of this will get unlocked in the form of transactions, and that's what we're tracking.
Barbi, how much distress do you expect to see in the market, and what percentage of these deals could implode?
Well, this week, the report was that 50% of the distress pipeline is office, which is not a surprise probably to anybody paying attention. But they did say that the rate of growth was the slowest for distress that it's been in in 2 years. I think that's positive and an indicator. A lot of the vacancy in office is concentrated in few buildings. Some interesting research again that Cushman Wakefield prepared on that, and you know, locally it's been minimal distress because we're on an institutional market, and the flight for quality has left us with some under demolished product, I think is the way that we like to put it. But it does, I think it does tell a story, this concentration in certain buildings of the performance of property by class, particularly in the office market. Curious what the others are seeing.
Allie, anything to add to that?
Yeah, so piggybacking on that a little bit, you know, I think as we think about distress, there's really two types of distress here. There's business plan distress, which goes in line with what Barbie's saying, what you can get done in office. But then there's also distress as we think about being able to get into extensions, being able to refinance or finance a new acquisition that's caused by the higher rates and the refinance gap. So whether we believe the forward curve or not, as rates begin to pull in, that refinance gap lessens. And so it will be interesting to see, you know, as deals come to market, how much of them are actually the distressed deals that are coming, and how much of it is, now that rates have pulled in, people can sell, people can have acquisition financing and move forward.
Okay. Just a reminder to all of you in the audience, we're about halfway through the hour now. If you do have any questions, we will be going to Q&A soon. Please put them in that Q&A tab at the bottom of your screen, and we welcome them. Allie, what's different this time than the Great Financial Crisis? How are banks and borrowers dealing with the wall of maturities differently this time?
So during the GFC, there was a vacuum effect. There was no liquidity in the market at that period of time. I think as we look at what's happened over the last 12 to 18 months, you know, we've seen a little bit of that as it relates to office, but by and large, there has been liquidity available in the form of life companies, agencies. CMBS has come back in this year. So that availability component is really different between the GFC and now. I think the other thing that we're starting to see right now, which gives me hope as we go into 2025, is that the larger banks, so the first banks that went out, the money centers, the larger regionals, are starting to come back in. It's still a little bit of a have-not situation where they're coming back in for their really strong sponsors and their long existing relationships. But that feels like it's getting a little bit better. I think where we're going to continue to see the distress in the bank space is going to be for the smaller regionals and the locals, who are not only continuing to work out the large real estate portfolios that they have, but also dealing with new regulations that are coming in.
Anybody have anything else to add?
I would just add also, and I agree, the regionals, I think if they had to mark to market today, would be in a world of trouble. So I think the regulators are helping them manage that process. The other big difference between the GFC is interest rates were a lot lower back then than they are today. So the opportunity cost for the banks wasn't as strong as it is today. You know, with rates being higher, you know, they can lend money, they can invest it at much higher rates than they could back then. So I think they had a bigger incentive back then just to kind of hang in there. And so, you know, we saw that play out over a long period of time. I think today they really have to move the stuff off their books.
I agree with you in large part. I think, you know, as we think about the ability to kind of kick the can, when there was no liquidity during the GFC, regardless of lender type, everyone was willing to kind of move forward because there was no opportunity to refinance out. Going to the earlier question of, you know, what are we seeing as we're getting towards extensions? The banks are really, those that have come back in, are asking their existing borrowers to refinance out. A lot of them don't want the extension options pulled. If you're not qualifying, they're asking you to go find debt elsewhere because they're trying to alleviate the large portfolios that are currently sitting on the books.
Yep.
Ryan, who do you see being able to get refinancing now?
I'm going to answer the question maybe in a slightly different way, because I think a
Okay.
lot of it depends on the property type and the collateral. I think if you have a pretty good, say, retail property, I think there's a lot of interest in that these days. Or if you are not in one of those industrial markets where there's a little bit of overbuilding pressure, certainly, like, we see this when we're, taking different property types out and testing the marketplace a little bit. So some of it's geography based. I don't want to discount that, but I do think, I don't want to, pile onto any property types necessarily. So I'll keep them like Voldemort, property types that shall not be named, sort of thing. But I think if you are one of those sort of more favored property types right now, even, hotel hospitality to a certain extent, seems like recently there's been a lot of interest in that. And so I think if you have good collateral quality, if it's a property type that is seemingly in favor among the ones that I've mentioned, maybe a few others, it certainly seems like if you look at any of the objective measures of lending activity, I think they're all pretty much pointing in the same direction over the last 2 to 3 quarters, which I take as a very heartening sign.
We've got good liquidity right now in the market. You can generally get any property type financed. It's at what cost is really what's driving it. So even the out of favor office buildings, you can get financed, but you're not going to like the rate that you're going to have to pay in order to finance it. So that's the crux of the issue. It's not the availability of capital. Thankfully, CMBS is going to have a banner year this year. They've been a really good release valve, and the unlimited capital that they can provide into the market, so long as they've got buyers for the bonds, and that market's been very healthy. So it's ultimately just a function of pricing.
Mm-hmm. So I guess the question is, how much do you see, or when do you see affordable capital picking up?
It's relative. It's relative. It's all relative. All of us have been in this business for a very long time. Financing at 6% was not expensive, and historically, it's not expensive. But when you get used to a period where you're borrowing at 4%, and you've modeled your investment and development to an exit that assumes low interest rates, that's where you run into problems. I think the market will do well, and again, pricing will need to adjust. We need to go through that the price adjustment period through some transactions, and some people are going to take losses. But I think, again, I predict most of those losses are going to be on the equity side, much less so on the debt side. And everyone's going to move on and find other opportunities based on a 6% world, not a 4% world.
Allie, any further thoughts on that?
I think the inflection point is, when do we get past negative leverage? And I think that's a big piece of what Shlomi is talking about. Not only do we need to see transactions so we can right size cap rates and really find that floor, but it's not sustainable to think that negative leverage is a long-term position. Shlomi is right. We're back to historical averages. I mean, spreads today are at the averages over the last 2 decades. So that part feels like it's pulled in. Now we need the equity piece to work in tandem and right size so that we can all move forward.
And rent growth will also fix a lot of it, right? If you can accept negative leverage today, if you know that you're going to get 3 to 4% rent growth on a go forward basis, and in 12 months, 18 months, be positively levered on your asset. Again, I think the challenge right now is really pitting what that rent growth is going to look like, and when it's really going to kick into some sort of historical norm.
And that was something we were talking about at our mid-year outlook, was the fact that even with office properties, though they're very empty, the stronger ones in the stronger markets are able to charge much higher rents. So they're getting more per foot for the feet that they are renting.
Yeah, I office in one of those markets in Century City, in Los Angeles, where the buildings are 95% plus occupied, and it's the landlords are able to really name their price for rent. And I think again on the office side, we saw this in retail coming out of the Great Recession. There was a overcorrection that happened in the market, especially on the investment side in retail. I personally believe that there is an overcorrection that's happening in office. We are hearing of employers coming back, and I do expect that most companies are going to require their employees to be in the office. So we will see that demand. It might be companies slowing down, but again, if we've got a healthy functioning economy, we're going to see new company formations and continued demand for office space. So it's tough to see that right now, but I think long term, if you've got the capital and are able to buy some of these buildings on a per pound basis, that's a great place to be in the market right now.
Along those lines, what will most attract investors in the coming 6 months or the coming year? For instance, do you see more of a drive toward risk aversion or value add, or what type of investor interest do you see? Shlomi, that would be for you.
So for us, I think yields on opportunistic investments need to go up. Again, as debt, whether it's corporate debt or senior secured debt, leverage you're able to get in mid-teens type returns, it's really tough to take equity risk and get a similar type of return and attract that type of capital. So I think what we'll see is opportunistic capital and value add capital creep up and demand higher returns in order to make those investments. If you've got the opportunistic capital right now and can be somewhat of a contrarian, investing in ground up multifamily development, which is a space that we're leaning into right now, is I think is a great place to be, and will be a great place in a couple of years when you're delivering units into markets with little to no new supply, and again, continued fundamental economic growth, just as we discussed at the beginning of this conversation. So that, or contrarian capital buying office and taking a longer term view on some office, I think are two areas with, again, opportunistic capital.
Let's talk about some of the other capital. Steve, how do you see pension funds viewing real estate investment right now?
Yeah, I think, it's been a tough couple of years for those in the fundraising business from pension funds, because, a lot of the pension funds made commitments in the, 20, 21, 22 period. And, not a lot of that money went out. And then more recently, they haven't gotten a lot of money back. And so they've really sat on the sidelines. I think there's some rays of sunshine as we look out into 25, though. One is you have this denominator effect, as the stock market continues to boom, the allocation, the real estate allocation is a lower percentage. So I think they certainly have room in their allocations. So that's good. I think there's the whole, fear of missing out, FOMO. They know that if they're not investing, during these, great vintage years where values have dropped significantly, they're going to miss out on some outsized returns. Thinking back to 2011 and 2012, what a great time that was to be investing. And I think, a lot of their existing managers are struggling, have issues in their own portfolio, so they're going to have a tough time, getting re-ups from these pension funds. So I think it's an opportunity for new strategies, new investment managers to kind of, raise capital and invest. But look, pension funds are long-term investors. They've been in real estate now for a long time. They have a healthy allocation, and so I see them to continue to be a source of equity capital. And that's, I think it was, hinted. I mean, that's in order to recap a lot of these assets and right size them, you need equity. I mean, you can't just do it with debt. And so that's a logical source where it's going to come from.
What about foreign investment? What do you expect that role to be? And there's a lot of tumult in the world right now.
Yeah,
How are
I don't
investors?
think you're going to see a lot of change. I think the foreign banks, I think, are out. I mean, they're getting clobbered right now. And just even in the last few weeks, I've seen, a German bank, a French bank, a UK, an Anglo bank, all trying to sell, either notes or loan participations. I mean, they're getting hammered between, COVID and the doubling of interest rates. I think insurance companies very interested, in credit, and I think we're seeing a lot of interest from that category, foreign insurance companies. And then I think you have the sovereign wealth funds that are just minting money, whether it's because of oil or whatever. And I think they're going to be players for some of these big transformative deals. And so that's probably where you'll see the bulk of it coming from offshore.
The foreign lenders are an interesting area. And I'd love to hear, Ali, Shlomi, what you're seeing there. How have the limitations changed for the foreign lenders, and what kind of role do you see them playing? And then I'd just like to talk a little bit about the lender mix in general going into this new year.
Sure. So thinking about foreign lenders, I mean, I don't think this is somewhere where we can just, one general statement and apply it to everyone. Each lender in each country from which they're coming from has their own set of regulations that's impacting the ability to lend. We are continuing to see international lender interest at the fund level financing. There's been a shift from property level to fund level. It's a way to continue to support real estate either through subscription lines or repo facilities for back leverage, while not having the direct exposure. And we're seeing international groups, just like their domestic counterparts, play there. And then also international banks specifically that didn't necessarily have as much office on balance sheet, depending on what country they're coming out of, they're still lending into the US market on a property level basis, but it's a little bit more of a needle in a haystack exercise to try to identify who's doing what and where, because the other piece is not every institution will play into as much of the US market as the domestic institutions will. So it might be the primary markets only, or a couple of East Coast cities that they'll lend into. And so that makes it a little bit more challenging to generalize.
I'll tackle the diversity. Actually, just this week, we learned of 2 new platforms that are in the works, or actually one was just launched and another's in the works. One is a major bank that's partnering up with private credit to lean into the non-recourse construction lending space, which is really dominated by 2 to 3 groups right now. So that's going to provide additional liquidity in the development side. And a second is a major investment management firm that just launched a private credit platform to try and compete with the types of lending and types of loans that the regional banks have historically provided to kind of middle market real estate investors and developers. So again, we're seeing a lot of liquidity available and a lot of demand from institutional investors to deploy liquidity in the credit space, and groups are leaning in and trying to finding opportunities to opportunities where there's not as much liquidity to provide that liquidity and make a lot of money on the back end of it.
We've got quite a number of questions coming in, so I'd like to turn to Q&A. And if we have time to go back to our discussion, we will. But first question actually is for Ryan, and that's, can you talk about the liability side of the balance sheet regarding investment?
I'll tackle that question pretty broadly, because if you look across the balance sheet in the U.S., in some respects, it's never been healthier. Household balance sheets have never been stronger. Net worth continues to hit record high levels. Debt service relative to income levels are basically at historical averages. I do think where there are some issues, Steve sort of kind of referenced this a little bit with what's going on in Chicago, or at least tangentially, is at more of the state and municipal level. I do think that there are issues with a lot of, state and municipal debt levels that are, the federal debt gets all of the headlines, but let's not pretend that that is the only thing that's going on. I do think that there are issues at state levels and at municipal levels that, they're going to have to start getting more serious about, even if it is kind of politically the third rail for them. But as far as household balance sheets and corporate balance sheets, in some respect, the private side of the economy has never been stronger in that sense. I really think it's more the public side of the economy where there probably needs to be, I'll just euphemistically call that some cleanup over the next, I'll be polite and say the next couple decades or so.
Okay, thank you. We have another question about industrial space for anybody who can answer it. How will tariffs affect industrial net absorption over the short term and the long term?
Well, let's hope positively. I mean, look, onshoring is something that, people have been talking a lot about, and the transition from just-in-time inventory to just-in-case. We're still seeing really strong online, retail sales. So, hopefully that may offset some of the port traffic that might decline from, higher tariffs. So to be seen, but hopefully it'll translate into more inventory being stored in industrial in the U.S.
Mm-hmm. Earlier, you mentioned changes in immigration policy potentially causing an increase in labor costs, particularly in border states. Do you believe this will be largely offset by labor and operational cost reductions driven by AI and other tech advancements? Wait a second. Where'd the rest of this go? Or do you believe that any non-border markets in particular will see outsized impacts from these advancements?
I think the AI observation or question is a good one, but there are certain industries where that just can't, pick lettuce and do some of the other things that are critical to our economy. But there are shifts, and being responsive to those shifts is important. In terms of non-border economies, Steve may have a better read on kind of the macro U.S. picture there.
Steve, do you have any further thoughts on that?
No, I was thinking she meant Ryan. Okay.
Or Ryan.
Not really.
Anybody?
My at least my broad thoughts on this is part of the problem is they're just, I'm going to channel my inner Donald Rumsfeld for a minute and say there are a lot of known unknowns right now, right? We just don't know how widespread they're going to be. We just don't know the level that they're going to be at. And so on a targeted basis, if this, because it's going to be difficult to implement this, I don't think anybody's really talking about the cost associated with that kind of policy. Like, it's not been funded. It's wholly unclear to me whether or not Congress would even fund that sort of effort. So if it's small and targeted, probably doesn't have that much of an impact. If we just imagine a scenario where we go to the nth degree, then it can be very disruptive. And then we'll really have to start to think about ways, if at all possible, to alleviate that. I think my general stance on this is setting aside, just leaving the immigration issue aside, we have a pronounced structural demographics-based labor shortage in the United States and almost every other developed economy in the world. So if we're going to put up barriers to entry, and again, I don't want to get lost in the political side of illegal immigration, but if we are going to be more restrictive about immigration in a world where we just have lowered the birth rate structurally over time, then the only way to fill that gap is through technology and productivity enhancements. And to Barbi's point, in some ways you could do that right away, and in other ways we're going to need to develop, produce picking robots over the next 30, 40, 50 years. But to me, the macro economy is like a big input output machine. You have inputs, you do something with it, and you get outputs. And as we sit here in late 2024, the major input to production is still labor. So if we are going to do things, again, outside of the political sphere, just in economics, that restricts the major input to production in the modern economy, then we are going to have problems, intended or unintended. So we need to be careful with that. Just, again, I'm going to leave the political arguments to people who are much more politically motivated than me. But as an economist, like if you're going to start reducing the inputs, then you're going to end up impacting the outputs. And that's just economics. That's not politics.
Thanks. Yes, good point. It's going to take a while to develop those robots. Next question. Wait a second. This is an interesting one. With reshoring of manufacturing along those lines imminent, as well as the AI-driven data center boom, how do you anticipate the U.S. power grid absorbing the increased demand? And what will be the downstream effects for other property types? So power questions, that's another really interesting topic right now.
Look, you're seeing access to power be a huge issue for industrial development. So that's, one issue. The other issue is sort of data centers. They're crowding out traditional logistics and industrial. Look at Dulles, for instance. The whole Dulles area is now like data center central for the US. So what's happening? The historic industrial users who can't pay that freight are moving further west. And so you're sort of seeing a lot of that. So it'll be interesting to sort of track. I mean, maybe we'll start building nuclear again. We did in Georgia. That's one answer. I don't know, but hopefully that'll also limit new industrial development.
Okay, Ryan, any input on the next recessionary cycle? Looking ahead to the inevitable.
So, I've been very loud and very, I think, clear on this over the last few years that I have argued that a recession was not inevitable. Even before the Fed started raising, once the Fed started raising, like this economy is just, it's incredibly strong. It's incredibly dynamic. It's got so much momentum, even with the labor shortage that I was talking about. We are really good at taking those inputs and turning them into outputs. I think left to its own devices, there's no reason why we shouldn't expect the economy to continue to expand until what I will call the latter half of this decade. The two sort of, I'm going to go again with this, but sort of known unknowns that could throw that off. Number one, if we just get some random idiosyncratic shock, right? We're in a world where the exogenous risks keep going up, not down. And so if you happen to get the wrong combination of those at the wrong time, then all bets are off in economics. The other one, which again, I not to be remotely political, but if we got the wrong policies, especially if we got the wrong combination of policies, again, we need to be really careful about the law of unintended consequences, because things that are politically expedient can often be massive headwinds for the economy if we're not careful about those. And if we pick enough of those at the same time, it will probably take one of those kind of low probability, high severity scenarios, but I don't think there are any guarantees ever in economics. So to say that that couldn't happen would be irresponsible. But it would take, I don't even want to say intentionally because it wouldn't have to be, but it would almost have to be intentional, where you just picked so many deleterious policies at the same time that it more than offset all of the amazing positive things that are going on in the economies. But If we don't get that, there's no reason to think that this economic cycle can't keep going, well into the latter half. My crystal ball gets murky past, let's say, 5-ish years, but there's no reason to think if we don't make one of those mistakes that this economy can't continue to expand. We had a 10.5-year expansion the last business cycle. We had a 7-8 yearish expansion before the GFC and the housing implosion. We had a 10-year expansion in the dot-com cycle. The business cycle, the expansion phases are getting longer over time. If we don't do something stupid and make a mistake, then there's no reason to think that the economy can't continue to grow, even if it's at a reasonable pace.
Okay, and that sounds like a good note to end on. So thank you all again for participating in this discussion. It's been really interesting. For those of you in the audience, we'll be sending you all a link when the recording is available. If you enjoyed today's session, we hope you'll be able to join us for our next CPE Voices webinar. And we also offer multifamily focused discussions through Multi-Housing News' MHN Voices webinars, so join us there as well. Thank you all for joining us. And again, to the panel, thank you once again.
Thank you.
Thank you.
Thanks, everyone.
Thanks very much.